Hello and welcome traders to the channel. Let's talk about something that I know is on everyone's mind. You're staring at the charts, you've got a dozen indicators flashing, lines drawn everywhere, and you're feeling more confused than confident. You see the market moving, you know there are opportunities, but you're paralyzed by the noise. You feel like you're constantly one step behind, buying the top of a rally or selling the absolute bottom of a dip. What if I told you that most successful day trading isn't about having a crystal ball or using 100 complex indicators? It's about having one simple, robust strategy that helps you identify high probability setups, a sweet spot where the odds are stacked in your favor. Today, I'm going to walk you through, step by step, a strategy that does exactly that. We're going to cut through the clutter and build a framework that gives you clear, actionable signals on a daily basis. This is the strategy that can help you move from being a reactive, emotional trader to a proactive, disciplined one. So grab a coffee to eliminate distractions, because this could be the most important trading lesson you receive all year. Now, before we dive into the charts and the nitty-gritty of the strategy, it is absolutely essential that we get the important disclaimer out of the way. Please remember that I am not a financial advisor. The content in this video is for educational and informational purposes only. It represents my own opinions, analysis, and the strategies I have found to be effective. Trading cryptocurrencies involves a very high level of risk and you can lose all of your invested capital. You should never trade with money you cannot afford to lose. Always do your own thorough research and consider consulting with a qualified financial professional before making any investment or trading decisions. Your financial choices are your own, and you are solely responsible for the outcomes. With that said, let's get into the analysis. So, to apply any strategy effectively, we first need to understand the environment we're operating in. What is the current market sentiment? As of right now, the word I would use to describe the crypto market is compressive. We're in a phase of consolidation and price discovery. After the explosive bullish momentum we saw earlier, the market is taking a much-needed breath. For Bitcoin, the king of crypto, we're seeing it trade within a well-defined range. This isn't necessarily bearish, it's more neutral to cautiously optimistic. Think of it like an athlete resting between sprints. The big players, the institutions, they're accumulating positions, while retail traders are getting shaken out by the choppy, sideways price action. This kind of market is actually fantastic for a disciplined day trader, but it's a minefield for an emotional one. Why? Because the clear, easy trend following trades are gone for the moment. Instead, the opportunities lie in playing the ranges, identifying key levels of support and resistance, and catching the smaller intraday trends that form within this larger consolidation. For altcoins, the sentiment is even more nuanced. They are, as always, highly sensitive to Bitcoin's movements. When Bitcoin shows strength and pushes to the top of its range, certain altcoin narratives catch fire. We see pockets of bullishness in sectors like AI, DePIN, or gaming. But when Bitcoin shows weakness and tests the bottom of its range, these same altcoins can bleed much faster. So, the overall sentiment is neutral with bullish undertones, but it demands precision. It's a scalpel market, not a sledgehammer market. You can't just buy anything and expect it to go up. You need a plan, you need to know your levels, and you need a strategy that helps you identify when to strike and when to sit on your hands. This compressive state is the perfect backdrop for the sweet spot strategy we are about to break down because it's designed to find clarity in the chop. Before I reveal the components of the strategy, let's address the elephant in the room. Why do so many aspiring traders fail? The internet is filled with strategies, indicators, and so-called gurus promising guaranteed profits. The problem isn't a lack of information, it's a lack of a coherent framework. Most traders fail due to a few critical errors. First, indicator overload. They plaster their charts with RSI, MACD, stochastic, Bollinger Bands, Ichimoku clouds, and 10 different moving averages. Instead of creating clarity, this creates analysis paralysis. The indicators often give conflicting signals, leaving a trader frozen with indecision or, even worse, allowing them to cherry-pick the one signal that confirms their emotional bias. The second reason is a lack of understanding of market structure. They trade against the dominant trend. They try to catch a falling knife or short a rocket ship, getting run over time and time again. They don't zoom out to see the bigger picture. And third, and most importantly, is a complete disregard for risk management. They don't use a stop loss because they're afraid of being wrong. They let a small losing trade turn into a catastrophic, account-blowing loss. They over-leverage, hoping to get rich on one single trade, and instead, they get liquidated. The sweet spot strategy is designed to combat all three of these failure points. It uses a minimal set of tools, forces you to align with a higher time frame trend, and has risk management built into its very core. It's not magic, it's a disciplined, repeatable process. So let's build this strategy from the ground up. I call it the sweet spot strategy because we are looking for that perfect point of confluence, where multiple, non-correlative factors align to give us a high probability entry signal. It's built on 4 key pillars. If you miss one pillar, the setup is invalid. You must have all 4. Pillar number 1 is market structure. This is the absolute foundation of all good trading. Before you even think about placing a trade, you must identify the trend on a higher time frame. If you are day trading on the 15-minute or 5-minute chart, your guiding light should be the 4-hour chart. Is the 4-hour chart making a series of higher highs and higher lows? If yes, we are in an uptrend, and we should only be looking for buying opportunities, or longs. Are we making a series of lower lows and lower highs? If yes, we are in a downtrend, and we should only be looking for selling opportunities, or shorts. If the price is moving sideways in a choppy, undefined range on the 4-hour, then we either play the extremes of that range or, even better, we stay out and look for a clearer setup on another asset. Trading with the high time frame trend is like swimming with the current. It doesn't guarantee you'll win, but it makes everything significantly easier. Fighting it is swimming against the current, it's exhausting and you'll likely drown. So, step 1 always is to define the 4-hour market structure. This is your directional bias for the day. Pillar number 2 is identifying key horizontal levels. Price does not move in a vacuum. It gravitates towards areas of historical significance where large orders have been placed in the past. These are our zones of support and resistance. Support is a price level where buying pressure has historically been strong enough to overcome selling pressure and halt a downtrend. Resistance is the opposite, a price level where selling pressure has historically overwhelmed buying pressure and stopped an uptrend. You need to go to your chart again, the 4-hour is great for this, and mark these levels clearly. Look for areas where the price has reacted multiple times. A level that was once resistance, once broken, often becomes support. This is known as a support/resistance flip, and these are incredibly powerful areas to watch. These horizontal levels are allocations for a potential trade. We're not just buying randomly in an uptrend, we are waiting for the price to pull back to a predetermined, high-value location, a key support level. This simple act of patience, of waiting for the price to come to you, will dramatically improve your results. Pillar number 3 is our dynamic trend filter, the exponential moving averages, or MA. While horizontal levels are static, the market is dynamic. We use 2 EMAs to help us visualize the short-term and medium-term trend momentum. Specifically, we will use the 21-period EMA and the 50-period EMA. The 21 EMA represents the shorter-term trend, while the 50 EMA represents the more established, medium-term trend. Here's how we use them. In a healthy uptrend, the price will be trading above both the 21 and 50 EMAs, and the 21 EMA will be above the 50 EMA. This confirms our bullish market structure. The zone between the 21 and 50 EMAs often acts as a dynamic area of support, a value zone where buyers are keen to step in on a pullback. Conversely, in a healthy downtrend, the price will be trading below both EMAs, and the 21 EMA will be below the 50 EMA. The area between them now acts as dynamic resistance. The signal we look for is a pullback. In an uptrend, we want to see the price pull back towards our EMA cloud. The most powerful setups often occur when a key horizontal support level, from pillar 2, intersects with one of our EMAs, particularly the 50 EMA. This creates a powerful zone of confluence support. This brings us to pillar number 4, our final confirmation signal, the Relative Strength Index, or RSI. Now, most traders use the RSI incorrectly. They sell simply because it reads above 70, overbought, or buy because it reads below 30, oversold. In a strong trend, this will get you wrecked. The RSI could stay overbought for a very long time in a powerful uptrend. We are going to use it in a much more sophisticated way. We are looking for divergence. RSI divergence is a leading indicator that signals a potential change in momentum. A bullish divergence occurs in an uptrend when the price makes a lower low, but the RSI makes a higher low. This indicates that even though the price has dipped slightly lower, the selling momentum is weakening. The sellers are getting exhausted. A bearish divergence is the opposite. In a downtrend, the price makes a higher high, but the RSI makes a lower high. This signals that buying momentum is fading, and the trend might be ready to resume its downward course. This is our trigger. It's the final piece of the puzzle that tells us asterisk might be the time to enter. So how do we put it all together to find the sweet spot? Let's walk through a perfect long setup. First, we look at the 4-hour chart. Pillar 1, we confirm we are in a clear uptrend, making higher highs and higher lows. Our bias for the day is long only. Pillar 2, we identify a key horizontal support level below the current price. This is a level where the price has reacted strongly in the past. Pillar 3, we look at our EMAs. 21 is above the 50, and the price is above both, confirming the uptrend's health. We are now patiently waiting for the price to pull back. The price begins to fall, coming down towards our pre-identified horizontal support level. As it gets closer, we see that our 50 EMA is also sitting right at the same level. This is a massive area of confluence support. We are now on high alert. We zoom into our execution timeframe, say the 15-minute chart. As the price touches this confluence support zone, it might even dip slightly below the previous swing low on this timeframe. But here's the key pillar 4. We look at our RSI. While the price made a small new low, the RSI on the 15-minute chart has made a higher low. Then, that is our bullish divergence. That is the sweet spot. We have the 4-hour trend on our side, we are at a major horizontal and dynamic support zone, and we have a clear signal that selling momentum is exhausted. This is our signal to enter a long position. The short setup is the exact mirror image. Pillar 1, 4-hour chart, is in a clear downtrend. Our bias is short only. Pillar 2, we identify key horizontal resistance level above the current price. Pillar 3, the 21 EMA is below the 50 EMA. We wait for the price to rally up to our resistance level, which ideally also coincides with the 50 EMA. Pillar 4, as price tests this confluent resistance zone, we look for bearish divergence on the 15-minute chart, price making a higher high, while the RSI makes a lower high. That's our trigger to enter a short position. By waiting for all 4 of these pillars to align, you're filtering out all the low-quality, noisy setups. You are being patient, disciplined, and only engaging with the market when the odds are significantly in your favor. This is professional trading. Now, a strategy without risk management is just gambling. This part is non-negotiable and is what separates profitable traders from the 90% who fail. Before you enter any trade, you must know 2 things: where you are getting out if you're wrong, and where you are taking profit if you're right. For our stop loss, the placement is logical. In our long setup example, after we see the bullish divergence and enter the trade, our stop loss should be placed just below the low of the candle that formed the divergence, or slightly below the entire support zone. This gives the trade room to breathe but defines our risk. If the price breaks below this level, our trade idea was wrong, and we get out with a small, manageable loss. For the short setup, the stop loss goes just above the high of the bearish divergence candle or just above the resistance zone. The second part is your take profit target. A simple way to set this is to target the next key horizontal level. In our long trade, you would look up on the chart and identify the next significant resistance level. That's your primary target. A more advanced method is to use a fixed risk to reward ratio. You should never be entering a trade where your potential profit is smaller than your potential loss. The minimum risk to reward ratio of 1 to -2 is a good starting point. This means for every $1 you are risking, you are aiming to make $2. This is a game changer. With a 1 to -2 risk to reward ratio, you only need to be right 34% of the time to be break even. If you can be right 40% or 50% of the time, you become a consistently profitable trader. Finally, position sizing. You should only ever risk a small percentage of your total trading capital on any single trade, typically 1% to 2%. This ensures that a string of losses which will happen to every trader won't wipe out your account. It keeps you in the game long enough for your winning strategy to play out. So, looking ahead, how does this strategy apply to our current market and a forward-looking statement? In this compressive, range-bound market, the sweet spot strategy is exceptionally effective. The ranges have well-defined support and resistance levels. Pillar 2. Within these ranges, we get beautiful, clean intraday trends on the 1-hour and 4-hour charts. Pillar 1. This allows us to wait for pullbacks to our EMA cloud. Pillar 3. And look for those powerful RSI divergences. Pillar 4. To time our entries with precision. Looking forward, when the market eventually breaks out of this consolidation phase and begins its next major trend, this strategy will be just as powerful. If we enter a new, sustained bull market, we will simply use the strategy to only look for long positions on pullbacks. If, for some reason, the market breaks down into a bear market, we will flip our bias and only look for short setups on rallies to resistance. The strategy is robust and adaptable because it's based on the timeless principles of market structure, supply and demand, momentum, and risk management. It's not a black box system, it's a framework for thinking about the market in a clear, logical way. To wrap this all up, remember that the goal is not to trade every day. The goal is to make good trades. This strategy is not about forcing signals, it's about waiting patiently for that sweet spot to appear. Some days, there may be no valid setups. On those days, the best trade is no trade. Your job as a trader is to be a risk manager first and a profit seeker second. Master this strategy, practice it on a demo account, learn to identify the 4 pillars with ease. Internalize the risk management rules until they are second nature. Trading is a marathon, not a sprint. It's about discipline, patience, and flawless execution of a plan. The market will provide opportunities every single day. With this framework, you'll finally be prepared to see them clearly and act on them with confidence. Thank you for your time today. I hope this breakdown was valuable for you. If it was, please consider hitting that like button, subscribing for more content like this, and let me know in the comments what you think of the sweet spot strategy. Trade safe, and I'll see you in the next one. Our pro music fades in.